Ladies and gentlemen, Asian Guy here, and after yesterday's explosive revelation about Shanghai silver hitting $102 while Western markets stalled at $86, we need to discuss what's happening next. Because that $16 premium wasn't just a price anomaly, it was a warning signal about something much larger developing in global silver markets. Today we're examining the physical availability crisis that's driving these unprecedented regional price differences, and why understanding this crisis is crucial for anyone trying to comprehend modern commodity markets. This continues our educational series on silver market dynamics, building on our previous discussions about market structure, arbitrage breakdown, and east-west trading differences. Today we're focusing on the physical reality behind paper price movements. Let me start with the fundamental concept that most people miss when analyzing commodity markets: the difference between price and availability. Price is what you pay for something when you can actually buy it. Availability is whether you can buy it at all, regardless of price. In normal markets, these concepts align. Higher prices reduce demand and increase supply until equilibrium is reached. But in physical commodity markets during shortage periods, price and availability can disconnect completely. What we're witnessing now is a global silver market where regional availability has become more important than price coordination. Shanghai buyers are paying $102 not because they think silver is worth more than Western buyers think it's worth, but because they need silver, and that's what it costs to actually obtain it in their market. This availability crisis manifests differently across global markets, and understanding these differences provides crucial insights into how commodity shortages develop and spread. In Western markets, the availability crisis appears as extended delivery times, higher premiums for physical products, and selective inventory at dealers. You can still buy silver, but it might take longer to receive, cost more than spot price suggests, or be available only in limited product categories. In Eastern markets, particularly in China, the availability crisis appears as absolute scarcity, driving prices to whatever levels are necessary to ration limited supply among competing buyers. When supply is insufficient to meet demand, prices rise until demand is destroyed or new supply is found. The educational insight is understanding how these different shortage manifestations create the arbitrage opportunities we discussed yesterday, while also explaining why those opportunities can't be easily captured. Let's examine the specific factors creating this physical availability crisis. Mining production constraints represent the foundation of the current situation. Silver mining is geologically limited and takes years to expand. Most silver comes as byproduct from copper, lead, and zinc mining, so silver production depends on demand for other metals that may not align with silver demand. When silver prices rise, mining companies can't immediately increase production like manufacturers can increase widget production. New mines take 5 to 10 years to develop. Existing mines have limited expansion potential based on ore reserves and processing capacity. Refining bottlenecks add another constraint layer. Raw silver from mines must be refined into forms suitable for industrial use or investment products. Refining capacity is geographically concentrated and capital-intensive to expand. When demand surges, refining becomes a bottleneck even if mining production is adequate. Fabrication limitations affect investment product availability. Silver bars, coins, and rounds must be manufactured from refined silver. This fabrication capacity also has limits, and when investment demand spikes, waiting times for popular products can extend significantly. Geographic concentration of production and refining creates vulnerability to regional disruptions. If major silver-producing or refining regions experience political instability, labor disputes, or infrastructure problems, global supply can be affected disproportionately. Trade policy interventions can artificially create or worsen availability crises. Export restrictions, import duties, or strategic stockpiling policies can redirect silver flows in ways that create regional shortages even when global supply is theoretically adequate. The inventory dynamics provide crucial understanding of how availability crises develop over time. Above-ground silver inventories have been declining for several years as industrial consumption exceeded mining production. These inventories represented decades of accumulated production that could buffer temporary supply-demand imbalances. As inventories decline, the buffer capacity decreases, making markets more sensitive to supply disruptions or demand increases. What previously might have caused minor price adjustments now causes availability crises. The rate of inventory decline has accelerated recently due to increased industrial demand from solar panels, electric vehicles, and electronics manufacturing. This acceleration reduces the time available to adjust to changing market conditions. Exchange inventories provide visible indicators of availability stress. COMEX registered silver inventories represent metal available for delivery against futures contracts. When these inventories decline rapidly, it signals increasing difficulty in obtaining physical silver for delivery. The demand-side dynamics creating availability stress are equally important to understand. Industrial silver demand is relatively price inelastic in the short term. Manufacturers using silver in production processes can't easily substitute other materials or reduce usage without redesigning products or changing production methods. When availability becomes uncertain, industrial users often increase inventory levels to ensure production continuity. This precautionary stocking creates additional demand that worsens the availability crisis. Investment demand can spike rapidly during periods of monetary or economic uncertainty. Unlike industrial demand, which is relatively steady, investment demand can increase dramatically in short periods, overwhelming supply chains designed for normal demand patterns. Government or institutional stockpiling can create massive demand spikes that private markets can't satisfy. When countries decide to build strategic silver reserves, their purchasing capacity can overwhelm normal supply channels. The regional aspects of the availability crisis help explain the price divergences we're observing. Different regions have different supply sources, refining capacity, and distribution networks. A supply disruption affecting one region might not affect others immediately, creating temporary regional shortages. Transportation and logistics constraints mean that silver available in one region can't instantly be moved to shortage areas. Physical silver is heavy and expensive to transport, so regional shortages can persist even when global supply exists elsewhere. Regulatory and trade barriers can prevent silver from moving between regions, even when profitable arbitrage opportunities exist. Export licenses, import restrictions, or payment system limitations can create artificial regional shortages. Currency and financing differences affect regional purchasing power for dollar-denominated commodities like silver. Regions with weak currencies or limited financing access may experience affordability crises even when silver is physically available. The implications of this availability crisis extend far beyond silver markets and provide important lessons about global supply chains and resource security. For industries dependent on silver, availability uncertainty forces difficult decisions about inventory management, production planning, and supply source diversification. Companies must balance the costs of carrying additional inventory against the risks of production disruptions. For investors, understanding availability crises helps explain why physical asset ownership might behave differently than paper asset ownership during shortage periods. Owning physical silver provides availability security that paper derivatives can't guarantee. For policymakers, availability crises in strategic materials highlight vulnerabilities in domestic supply chains and economic security. Countries dependent on imported silver for critical industries may need to consider strategic stockpiling or domestic production development. The educational value extends to understanding how modern, just-in-time supply chains cope with availability crises. Systems designed for efficiency during normal periods can become fragile during shortage periods. The timeline aspects of availability crises are crucial for understanding their development and resolution. Availability crises typically develop gradually as inventory buffers are consumed, then accelerate rapidly when buffers are exhausted. The transition from normal market conditions to crisis conditions can happen quickly once tipping points are reached. Resolution requires either demand destruction through higher prices or supply increases through expanded production. Both processes take time. Demand destruction requires users to find alternatives or reduce consumption, while supply increases require capacity expansion or new source development. The recovery phase often involves rebuilding inventory buffers that were consumed during the crisis period. This rebuilding creates continued demand even after supply-demand balance is restored, potentially extending elevated price periods. Market participants often overreact during crisis development and resolution, creating volatility exceeding fundamental changes. Understanding these psychological dynamics helps explain extreme price movements. Inventory to consumption ratios provide better crisis indicators than simple price movements. Delivery times and premiums signal availability stress before official statistics reflect problems. Regional price differences indicate stress in specific areas not reflected in global averages. Availability crises develop gradually as inventory buffers are consumed, then accelerate when buffers are exhausted. Resolution requires demand destruction or supply increases. Both take time. And recovery involves rebuilding buffers. This is Asian Guy, and yesterday's $16 Shanghai premium represents a shift from normal market conditions to shortage economics, where availability becomes more important than price coordination. Understanding these dynamics explains not just silver markets, but how any physical commodity behaves when supply-demand balances become stressed and inventory buffers are exhausted in our connected but physically constrained global economy.